and welcome everyone to Rose Cup webinar series. This is the number 12 that we're running since 2 years ago. And today we have invited Mike, our advisor, one of our advisors, back to go into depth on FX as a topic. Welcome, Mike.
Thanks very much, Q. Lovely to be here.
And for the people who don't know me, my name is Chaojia, or Q for short. I'm the co-founder and CEO of Rosecut Technologies. Rosecut Tech help people to find financial freedom at scale. That's what we do. We talk everything about your money and how to maximize your probability of getting to your financial freedom at your definition. And Mike used to be a colleague of mine for many years at Credit Suisse Private Bank. We have left one after another quite a few years ago, before the recent news that you see in the news, obviously. And but I have to say, you know, from a private banking perspective, it is a great place for one to get the access to the knowledge and help and service to look after one's money holistically. And that kind of service does not exist, unfortunately, for people who don't have 5-10 million to start with. But this is why Rosecut exists. We're trying to provide a similar service. And before we start, here's a quick risk warnings that we're talking about money, we're talking about investment. So investment can go up or down. There's no guarantee that you will get the return. But I would also say that even though past performance does not indicate the future, this is one of the only better measures you've got. And if you don't invest the money, it gets eroded by inflation surely and gradually. If you do, you have a chance of making some return or making some losses. So there you go. That's my alternative risk warnings for people. So today's agenda, we are following our usual three sections. First of all, we're talking about the shifting global currencies, very noticeably GBP recently. And second, we will talk about what other options are out there. What should you be doing with your money? We will give you actually some surprising comments that you may not expect. And then we're going to talk about how you actually can do it for multi-currency citizens, which I understand that's the majority of our audience here. We're all incredibly international, come from one country to live in the UK or moved away from UK, having, you know, bank accounts, investment accounts all over the place in different currencies. And it becomes difficult to manage as your life progresses by. And in the end, we will have a poll to get your vote for what we should be talking about in the future webinars. So please do express your choice and preferences. And Q&A will be saved for the last 15 minutes of the webinar. But please do ask questions as the presentation goes along. So ask the questions in the Q&A or chat, either way. And our colleague David here can help to organize those questions and answer some of them live, answer some of them in the chat before the end of the session as well. So that's the logistics out of the way, and let's go. The first section, understand the shifting global currencies. And UK has been hitting the headline recently for the past months too. Why is that, Mike? Can you give us a quick update for the people who, you know, need to understand the full picture but have not got a chance to follow the Financial Times on a daily basis?
Yeah, well, I guess the full drama of UK politics has been played out in the currency markets, and that's a rare thing for the UK. The pound typically has been quite stable. I mean, the good and the interesting news is that the pound is up about 15% on the last 2 or 3 weeks since the low when Kwasi Kwarteng's budget was announced. We dipped down towards parity with the dollar. Just to give you very long-term perspective, you go back to the 1950s and £1 would have bought you $4. You go back to the US Civil War, and £1 would have bought you $10, and now we're close to parity. So what we've seen historically is I guess, an erosion, steady erosion in the value of the pound. I'm going to stop there and just try and give a quick lesson about FX movements. And I should sort of caveat my comments by saying that trying to get currencies right is probably the most difficult thing in investment strategy. You can get equities right, bonds can be straightforward most of the time, but currencies, it seems to me, have a kind of a mind of their own. And I just to maybe oversimplify things, I will divide the currency world in two. So you've got the large developed world currencies, the euro, the dollar, the pound, the Swiss franc, the yen. And for most of the time, they tend to be driven by interest rate differentials. And for much of the last sort of 10 or so years, there's been a kind of a stability of interest rate differentials between the main currency zones. And if anything, it's been driven by the quantitative easing policies of the major central banks. So we've had a kind of a period of general stability for currencies. In emerging markets, currency markets tend to focus on not just interest rate differentials, but also political risk. The best example I can think of is Turkey with its president, Recep Erdogan. He's pursued a policy of steadily, continually meddling in the investment bank, in the economy, devaluing institutions, and the currency has responded to that. It's just steadily withered away as people in Turkey want to take money out, and people outside Turkey dare not put money into the Turkish economy. So that's a good example of a country where political and institutional risk is really bearing down on the currency. And typically when you get currency crises, they tend to be driven by factors over economic credibility, political crisis, and the degradation of institutions. What's happened in the UK is kind of a mixture of the two things, and to some quarters, and it should be said, to a lot of hedge funds in the UK who publicly at least are supporters of the Tory party. They have begun to price in a lot of political risk, and I think this has got a very it's got a very kind of long story, long background, going back to Brexit. I'm not being political in any way, but if you trace back to Brexit, the drivers of the UK economy, things like productivity, investment, have all dropped off on a trend basis. So less capital is being used, and it's being used less well, and typically that tends to weaken a currency. And then we've had political volatility, partly because of Brexit, partly because of the turmoil in the Tory party. And what markets have begun to do is to understand that that kind of volatility leads to more changeability in policy making. So if I go back, for example, to Tony's Blair government, he effectively had one chancellor in place the entire time. They gave independence to the Bank of England, and that sort of bolstered the institutional view of the UK. The opposite has happened this time. There's been a lot of musical chairs, a lot of changeability in policy. Much of that has not really been to bolster long-term growth, and also there have been public squabbles with the Bank of England. So people are getting nervous that, if you like, sort of the quality of the UK is being degraded. And then we saw that expressed in a very volatile way with Kwasi Kwarteng's budget. So in a way, it's no response that sort of the markets have forced the hand of politics in the UK and helped to lay the ground for a prime minister who is perceived to be market friendly, who understands the risks of upsetting markets, and that's now being priced in. Just before I stop, Q, maybe two points. One, I think the UK economy really needs to get growing again since Brexit. It has been underperforming the European, the US, and many other economies. And also, I think as background, one of the things that has made life difficult for the pound and many other currencies has been the strong dollar. And the dollar has been very strong because inflation is high in the States, and there's an expectation that the Federal Reserve is and will react to that by raising rates. And as they raise rates quickly, that attracts people who want to put money into dollars because they can earn a bigger yield. So a lot of money has been flowing into the dollar because of what the Fed has been doing. Secondly, those higher rates are causing stresses around the world economy. And those stresses, when they come, they push investors and some companies to safe havens. So they want dollar assets. So that's created even more demand for dollars. And what we've seen recently is that the dollar has risen probably more than it, or as much as it has at historical extremes, up to about 114, 115 in terms of the dollar weighted index. It's come back a bit. And as the dollar has risen, that's put downward pressure on other currencies, the euro, the pound, in particular the Japanese yen. And the Japanese yen has had a huge devaluation, some 40%. So it makes the pound look actually almost stable. So there's, I suppose, just to maybe stop for a second, there's two stories going on here. One is the very specific story around Brexit, politics in the Tory party, the pound, and people actually speculating against the pound, and then the strong dollar story. So what's happening now is that, you know, people having been...
Sorry, recap. I think what you just have said. So basically we divide the currencies in the world into developed country currencies versus emerging market currencies. People usually believing the developed market currencies a bit more because they have stable government and relatively stable currency, versus the emerging market usually get the perceived as more volatile depending on how credible people believe their governments are. Turkey is a negative example. Now, UK has been perceived of trending from developed market currency to behaving like an emerging market currency because we got a new prime minister who launched funny mini budget that unstabilized the market, should we say that? So that triggered some actions in the market, such as people stress selling, players selling, as well as people speculating. So, you know, that has made British pounds drop in value. But a very important point you mentioned, like that we're going to delve into later on, is actually GBP is not that bad if you compare on an international level to other currencies like Japanese yen or whatever. The truth is US dollar appreciated against everybody else. So, you know, GBP that we hold is one of the, you know, relatively losing out currencies, but definitely not the worst. Does that sound right as a quick summary?
That's a good summary, I think. Yeah.
Great. And then so you were just, edging on to the second topic now. What's the impact on the UK economy? Now, the first, the Prime Minister who have done this funny mini budget is gone. We've got Rishi coming on to the stage now, and we had a massive U-turn on the mini budget. So what's your view on Rishi, given his hedge fund and Stanford MBA background and ties, you know, closer ties to the business world, but still part of Tory. So what's your view? Or let's say, you know, what's your view on what he's going to do and whether that's going to help us to get back on the growth engine post-Brexit, like you mentioned?
Yeah, so I think he is unusual. He's probably more like all the people on this call than any other former prime minister, in that he comes from a kind of finance industry-centric world. he has an MBA. He's the first prime minister with an MBA, for example. So I think all of that makes him quite cautious about market volatility, which I think is one of the reasons why the pound has rallied. What I don't know is, does he have a really strong philosophy about how to create economic growth? And will that philosophy come through amidst the need, or what he thinks is a need to introduce austerity? And is this a good time to introduce austerity as we potentially are going into a recession? So it's a very, very big question mark. I think the areas he's comfortable on are the economy, domestic policy. He and his cabinet will be quite right-wing. And again, that may be a political danger for them as we go into a recession. The polls are against him, and he has Boris Johnson and about 30% of the Tory party dead set against him as well. So I think he'll certainly survive longer than Liz Truss, but I don't rule out the possibility that he runs into some sort of political, social crisis as we get into the late second half of next year. I think the area where he knows least and where he's least curious is foreign policy and things like Northern Ireland. And that's actually quite good, because I think some of the previous prime ministers, Johnson, Truss, have maybe unnecessarily picked fights with the EU over Brexit, or even the US. And I think the absence of friction on that scale or that plane will actually be a good thing, or would be a relative positive, and again a relative positive for the UK. So I think, just to sum up, a lot depends on the global macro outlook. I think if there's going to be a global recession, the level of suffering will be quite high in the UK because of austerity, because of lower growth and higher inflation. Remember, the UK has got 10% inflation, and it will be a big test of Rishi Sunak to see how he actually deals with that and tries to lead through that period.
So do you think austerity is the right path? Do you believe that's the right path for UK to go under, or not?
I have a very, to be quite honest, I've got a very different view.
Please share your different view.
Yeah, so my different view is that, if you look at countries, open economies that are very successful in terms of having high growth rates, many of them are neighbours of the UK, Denmark, Norway, Sweden, Ireland, as an example. Then further afield, you've got Switzerland. I mean, they invest massively in education. They've got very redistributive social policies or tax policies. So there's a sort of they create a broad middle class. They're very good at fostering companies and fostering innovation. So my view of what needs to be done in the UK is massive investment in education, training, reskilling, not just actually in the London area, but actually in all regions of the UK. Secondly, I think I would try, if I was him, just to put to bed all of the concerns around Brexit, Northern Ireland, etc. I think you just need to draw a line and move on, and focus wholeheartedly on the economy.
Great. That's a very thoughtful answer. And so, if we are going down this austerity path driven by the new prime minister, and UK's growth engine looks pretty grim for the next several years to come, and then one question I get asked a lot by our clients is that, should I dump my British pounds? And if I do that, why exchange?
So we would be very careful and almost loath to tell people to try and, to speculate on currencies, because it is such a hard thing to get right. And I think what's happening, the market dynamic, I think for the next couple of months, is this unwind. You can see it on the chart there. The pound to the dollar, we're still at the lows. So the dynamic, I think, is still at the moment with a little bit of an unwind in the dollar, money coming back into the pound, on the kind of the Rishi Sunak election. So I think now is certainly not the time to dump your pounds. I do think next year would be a difficult year in markets, and we'll see more and more volatility. So I think if we saw a rally in the pound up into the high 20s, what I would do is I would shave off a bit. It all depends on whether you know what do you need the pound for. And I think it was Harold Wilson said, someone commented to Harold Wilson, who was a prime minister about 50, 60 years ago, on the value of the pound. He said that the pound in your pocket is still a pound in your pocket. And what he meant about that is that, you know, for people living and spending and investing within the UK, the external value is not, I wouldn't say it's not relevant, but it has less relevance than if you have an international view. So certainly if you're an international citizen of the world who's living in multiple states or jurisdictions, and if you tend to invest very globally, then you should look to manage some of your pound exposure on strength rather than weakness. And I think I'd wait for this period of dollar strength to unwind. But I think you can also access a whole range of investments in the UK that are international in their scope, without having to dump your pound. And then the other consideration, I think, is what is your lifestyle? Do you need to spend X number of euros or dollars? And you just got to do some sensible financial planning. We've got some tools to help you with that, I guess.
Great. You've already mentioned that. Thank you, Mike. So I think there is actually a case study here I want to briefly mention, is that, you know, we've recently got a client who has large lump sum from a successful secondary. He got from selling a slice of his ownership in a tech company. And by the time that he got that money, that was the weekend where the pound went down like crazy. And we were trying to look at the situation and saying, you know, whether we should, he wanted to exchange from pound into US dollars straight away, no matter what. And actually that is selling pound at the weakness. And actually now you're looking back, you know, he pretty much sold it at this lowest point here. And so it is very sad when situations like this happens, when clients are already in panic zone. It's very hard for us to change their mind. So by the way, this is the purpose of us, you know, having those webinars along the way to talk you through those potential scenarios, so you have the knowledge to arm you against potential emotional volatility at those moments. Last slide before we move into the next section is the UK annualized real returns. Mike, what should we read from this?
Yeah, I mean, so there's, you know, in the world of FX, there's really only one currency that keeps its value, which is the Swiss franc. And that's due to the specific kind of institutional structure of Switzerland. So what the chart shows you, and this is a project I've worked on for a long time, is kind of long-term historical returns on UK assets. And you can see, you know, part of the graph shows the average return going back in time. With respect to the pound, you see that the pound loses a little bit of its value every year. It's probably lost an awful lot more this year, which suggests that there's probably a bit of catch up to the upside. But it also shows you the kind of returns you can expect on UK assets, be they bonds or equities, on average over time. And again, we encourage people to take a longer view of investment, and as you just pointed out, not to try and get emotional at market bottoms or market peaks. And usually, you know, as a rule of thumb, when a currency or an equity or a bond collapses, that's probably and it makes the news headlines, it's probably the wrong time to get out of it, because you're playing into this kind of moment of intensity when you have a lot of forced sellers. What we do, and obviously it's easier said than done, is try and cut positions when we're at peaks and euphoria. So, if I was to recommend any kind of currency view now, it would be kind of just to edge a little bit out of long dollar positions into other currencies, because that long dollar is just beginning to come off now.
Great. That does not constitute as advice. We're just talking about
No.
scenarios. Yeah. So in terms of individuals, and when they are thinking about, how to structure their assets, such as holding. So actually, this is a section where we actually would talk about, there are different layers of your assets. There's what currency is it in, and second, what regions are you investing your money allocated to, and what asset classes like bonds versus equities, and what industries like tech versus industrial versus consumer. So we're just talking about one slice here, right? Like in terms of what currencies to hold. Our key view is that assets and purchasing power is measured on a global scale. I actually quite disagree with what Mike, you quoted with the previous governor's point of a pound is a pound. It probably was that case before this whole globalization and anti-globalization that you recently wrote about, right? Like if we go to a UK supermarket, we buy the fruits from Peru, the vegetable from Spain, and the goods from all over the world manufactured in China. So all the different countries' exchange rate versus GBP does impact our purchasing power on a daily basis in the 21st century, right? So our purchasing power are impacted by the FX movement. But interestingly, you talked about Japanese yen and other things. So can you give a quick international context in addition to the point that, US dollar has risen against everybody else? Where does it go from there? And how does GBP stack up against the others? For example, how do we think about GBP against euro and other major currencies we should care about? What about RMB?
Okay.
Appreciating
so
much. All that things.
So I think there are potentially a number of opportunities, and again, the way to look at FX at the moment is the dollar. The dollar is the anchor. It's involved in over half of the transactions for everything globally, and then the second biggest currency is the euro, involved about 30%. Then I think you've got the pound, the yen, the pound, the Swiss franc, and the renminbi. But the dollar is easily dominant. So I think the FX world is really dominated by what's happening with interest rate and inflation expectations in the US. And I think if you get a fall in inflation expectations in the US, you probably get a big fall in the dollar, partly because so many investors are long the dollar and they've kind of crowded into this as part of this flight to safety. So that could actually be quite dramatic at some stage in the next 6 months or so. You just get this relaxation of interest rate and inflation fears, and the dollar unwinds on all of that. And if that happens, then you'll see the yen rally very strongly, probably the euro and the pound as well. Of the major currencies, the one that is maybe most interesting on a kind of a speculative basis is the yen, because for a whole range of reasons, Asia and particularly Japan hasn't seen the kind of inflation that you've seen in other countries, notably in parts of Europe where the war has played a role, or in the US where service price inflation is very, very high. And as a result of that, people pricing in different rates of inflation, the yen has kind of collapsed and the dollar has been strong. And the Japanese central bank, the BOJ, is now starting to intervene just to hold up the yen, because it's always becoming, I think from a kind of a currency speculation point of view, if I'm allowed to say that, the yen is probably the most interesting one if you're going to get this change in dynamic in terms of the inflation expectations across the big economies.
I see. So what do you think, again, we don't encourage people to speculate in currencies because it is one of the hardest market, as we mentioned.
Exactly. Yeah.
And Mike, if you are thinking about the drivers and risks of the global FX market, you just mentioned that US might have make a change to their policy, and it's a crowded place for a lot of people who already went into US dollars, so that might be a driver. What else do you think might bring substantial impact to the FX market?
I mean, I think it's largely that the main story is just inflation and rates and positioning, and then I think at the margins, it's kind of the nuanced views of different central banks. So, for example, the European Central Bank has been less aggressive in raising rates than the US because European economies are suffering because of the war in Ukraine, and there's a belief that a lot of the inflation in Europe is caused by that event. But if that high level of inflation was to persist, then they would really have to pick up interest rate rise, and you'd probably see a rally in the euro with that. So that's probably the main marginal factor, I think.
Great. I think there is some speculation in the markets, or let's say not speculation, that some of the investment banks come out to say, well, to really cure the inflation, the central bank's policy has to basically speed up the interest rate hike to allow the economy to go into a recession. That's the only way to lower the demand, therefore lower the inflation. And do you agree with that statement? And do you think Europe's different read, like you said, they think the war is driving the inflation rather than the demand? So let's talk about more on the supply side and things like that. Do you think they are behind the policy curve, basically?
Yeah, I think that will be a failure if the central banks have to engineer a recession to break inflation. It's a bit like saying you have to crash a car to slow it down. And I think much of the inflation we have has been fueled by years of quantitative easing, particularly the policy and fiscal stimulus after COVID, and that arguably wasn't taken back quickly enough. So I think I would lay a lot of the blame at the door of the central banks here. I do think we'll probably dip into a recession, a formal recession, early next year. Many of the lead indicators, the things that begun to rise quickest, such as the price of used cars, the price of lumber, they're all now collapsing. The US housing market is beginning to slow. We're beginning to see profit warnings from kind of key US companies like Amazon, which was actually quite interesting. So that looks like it's beginning to happen. And I think what we may have a very kind of confusing outcome in that the central banks, once greeted by this recession, they then stop raising rates, and then we arrive at sort of a monetary purgatory where rates are higher than they should be, but not as high as they have been this year, i.e. inflation of 3, 4, 5%. And that just makes for a very volatile kind of market outlook. And that wouldn't be ideal either, I think.
I see. That's so that makes our asset allocation for 2013 an interesting job to do. So what's your thoughts?
Yeah, so we should say at this point, when we at Rosecut go into the end of this year with a relative performance level that's actually really impressive. I mean, I think 5-6 percentage points better than the benchmark. I'd love to take credit for that, but I can't. It's all the work of our colleague Dan, our head of portfolio management, and we have about 30% of some portfolios in cash, which historically is a really big number. Many institutions only have 5 or 6% in cash, and the rest they're stuck in underperforming assets. We've had the ability and the flexibility to be really cautious in this extremely challenging environment. And I think that's bearing great dividends for the people who invest with Rosecut. And I think as signs come through of a kind of decisive bottom point in market, we would put that to work. So I have a sneaking sort of suspicion that we haven't seen the end of volatility yet. We've had about 3 big sell-offs this year. And each one has bottomed out at around sort of the level of 3,600 in the S&P. And then we've had these sharp bear market rallies, and I think we're now in the middle of another sharp bear market rally, which will probably take us to about 4,000 something on the S&P. My concern is that there's a lot of damage now being done to companies within economies, and that this damage will become evident as we get into the end of this year, beginning of next year. And maybe what happened in Britain was just a taste of that. So I don't think we're quite out of the woods yet in terms of market volatility, and that's how we're positioned. I think what is interesting is that a lot of assets that were expensive are now getting very cheap. So, an example was Amazon, which is about halved in value this year, hit $90 last week, has bounced a little bit. Meta, the former Facebook stock, is down about 60-something%. So a lot of these assets were very expensive. Now they're coming back into value territory, and they still have a lot of growth in the long term. So I think what's happening is that we're kind of cleaning up, if you like, the investment universe. You have fewer expensive assets and more opportunities for when that buying point arrives.
Great. I think that's, well, first of all, you should take the credit for the amazing outperformance we have this year as well. For people who don't know, since inception in 2019, we deliver on average 3 to 4% outperformance against the benchmark. But this year, despite the most challenging market condition, we are, 5 to 6% compared to the benchmark, which is a great achievement. And by design, Mike, from day one, you allow much higher than average private banking mandate to allow, up to 25%, 30% cash that, give the portfolio manager, Daniel, enough freedom to express, his convictions on the market. Yeah. Now, he got his convictions right.
He's done a great job, yeah.
Yeah, and but you got the design right. So you should totally take credit for that. And also, I think this is what exactly Daniel and I were talking about our webinar last month. The scariest moment is actually some of the assets that could deliver long-term value become interesting in terms of pricing. So this is where, by the way, when we talk about asset allocation, we're talking about what us as a professional money manager will do to the portfolios, not encouraging our clients to go dab around themselves. We're not suggesting buy Amazon tomorrow. We're talking about our logic of why we are holding lump sum cash up to 30% this year and potentially throughout to the beginning of next year, and why we are watching certain assets closely and ready to press the button to jump in when we see the opportunity crystallizes, right? So this just is a quick sharing of that. And then, I'm going to quickly talk about investment planning for multi-currency citizens. And this is where the concept of spending currency and investing currency that I would like to introduce. So basically, first of all, people are earning certain currencies out of their employment or out of their entrepreneurship in a single currency. So 70-80% of Rosecut clients are UK based. So you are earning GBP, but GBP doesn't have to be your investing currency. Your investing currency should be your long-term lifestyle planning currency. So for example, if you decide to spend the rest of your life in the UK, then yes, hold a GBP, or majority of them in GBP makes sense to reduce the friction between your purchasing power and another currency. But if you plan to leave UK in a couple of years and move to a country, then maybe US dollar should be your main investing currency. So this is based on lifestyle, not based on the GBP US dollar exchange rate today. As we talked about, it's really speculative and difficult for people to do. And second, when you're internationally mobile, being different countries, effectively the existing financial system doesn't serve you well, because you have to do paper account opening in every country, get a tax advisor, financial advisor in every country. That quickly becomes prohibitively too expensive. So this is why Rosecut is built as a digital financial planning and investment tool that allow you to invest the money with us no matter where you are. And we provide US dollar and GBP denominated investment portfolios. Again, you choose the currency based on your lifestyle needs. And we're happy to have a conversation to guide you through that decision process as well. And we have 3 different custodians in 3 different global jurisdictions: Wealth Kernel for the UK, Cradle for UK and Jersey, and LGT Bank for Leicester. So this is a good setup for people who may be in the UK, maybe in different countries in the future. And I'm very glad to unveil review our new product that we have recently launched last week for both iOS and Google and web app. So we built your wealth balance sheet professionally, and we show you your net worth, and you can work on how to improve that. And then we show you how long it will take you to achieve financial freedom. And we can help you to optimize your spending and investable assets to get you there quicker. Financial freedom is defined as when your assets generate enough income to cover your daily expenses, so you no longer have to work for money. So it's not the dream place everyone wants to be. And we are the first provider to build that tool and put it into your hands and let you use it for free. Of course, we charge a fee if you let us manage your money in addition to that. And then this is coming soon feature where we lay out the different accounts that you own and GIA and in different currencies, and we show the combined performance of them all. So it's very easy for you to have UK pension, UK ISA, offshore general investment account, all with Rosecut. And we show you the performance of all these different portfolios. It can be at different risk levels. And then, we can combine to show you the performance and how you are measuring up on your path to reach your financial freedom. So this is to be launched as a next version, but we just wanted to give you a quick sneak peek of what's coming up. And that's the quick presentation. And here, please take our poll to tell us what you think about this webinar and what you are interested in hearing about next. So there's single choices and there's multiple choices on the topics that you want to know. Please, if you can, click on the webinar poll that's showing up now. That'd be really helpful. And meanwhile, please ask your questions about what we talked about in the webinar. Any question about the UK politics, certain countries, or what's our view on the investments in a specific area, anything that you can think of. Okay, the first question, but Gabriel, is there a correlation between inflation and currency value?
There is in a sense, it's hard. It's a hard one because we've just come out of a period of 20 years where inflation has been incredibly well behaved and generally very low, sometimes mysteriously low, and currency values, if I think about them, have tended to respond in the developed world to kind of mini crisis around about balance sheets. The Eurozone crisis being the obvious one, the pound and Brexit being another one, 1 or 2 episodes where it looked like China was going to devalue. So there's a very light correlation historically. the last 1 or 2 years is actually quite different. And I would say that there's a correlation between a currency and the credibility of and the willingness of a central bank in that country to tackle inflation. So, for example, the feeling has been that in the US, a lot of the inflation is generated domestically, and the Fed will try and jump on that and raise rates aggressively. Obviously, in Europe, there's a sort of sense that inflation is a bit more mixed. So I think credibility of a central bank to tackle inflation is probably the driver.
What's your view? I think last year or the year before, we published one of your blog articles, mostly talking about the difference between CPI, i.e. consumer inflation, versus assets inflation. You know, consumer inflation is because of globalization. We get cheap supplies of labor somewhere else.
Yeah.
Like the, Eastern Europeans working in London, or goods manufactured in Asia, versus asset inflation. So how do you weigh these two things against?
So for a while, when all the central banks were doing QE and buying assets, there was sort of a mystery that inflation wasn't rising, and many economists felt it should do, and it just came with a lag. What did happen, however, is that asset prices began to rise quite dramatically. So property prices rose dramatically in Europe and the States and in the UK. Equity values, post-COVID rose dramatically. So the start of this year, the S&P was 4,800, etc. So asset prices are more sensitive to monetary policy and monetary policy easing in particular. Consumer prices, I think, are a bit more varied. And what we've seen, I think, is that with the breakdown of globalization, globalization was associated with low inflation. And, China, as you said, China exporting deflation, companies being very competitive across supply chains. And as all of those things have been disrupted, inflation has taken off. So for me, to an extent, high consumer inflation is almost proof that globalization is on its knees.
Very helpful. And second question from anonymous attendee is it a good time to use GBP to buy foreign assets if the exchange rate is good? I think depending on the definition of exchange rate, but how do you define, how do you read this question?
If you want to buy a house in Turkey, a holiday home in Turkey, maybe, because the Turkish lira is still very weak, but the pound is still quite cheap compared to other major currencies. So probably the timing is not ideal yet.
Okay. And again, let's reiterate that point again. If you use GBP to invest, that should be for lifestyle reasons, or keeping GBP or selling GBP rather than because you think there is a currency opportunity. It's incredibly hard to do. And Petro asks, what is happening on a gilt market? So UK government bonds. Any projections for next 6 months? Any predictions, basically? What's your view on UK gilt?
So we've just had an incredibly volatile period in the gilt market because of what's happened with politics and also inflation. So I would hazard that inflation is peaking, I think, internationally. And I think with that, bond yields are probably peaking as well. So I think the peak in UK yields was about 4.3, 4.4%. And I think that will still be the high point. I mean, we're right down now to 3.5% for the 10-year. So I think we've probably hit the peak already.
Great. That's a very clear answer to the question. Thank you. And is there any further questions from the audience? We've answered 4 so far. Okay, great. It's one of the very rare times we managed to finish on time. So thank you everyone for attending the webinar today, and for the ones who asked the questions as well. And we look forward to seeing you again. And thank you, Mike, for
thank you very much. Pleasure.
Today. Bye, everyone.
Bye, guys.